Do I think any of these wearables are a sustainable business model longer term? No, but it's always a question of timing, right? I think a lot of times a familiar product, investors on the retail side like to get involved because it's something that they know and they have understanding of the look and feel.
Hi, Miriam.
Hi, Telis.
So in today's show, we're going to be talking about one-hit wonders. Actually, that topic got me thinking. This weekend at a movie theater near us, they were showing the movie Ferris Bueller's Day Off, which is an all-time favorite of mine. But interestingly, and I did not go to see this, so don't ask me if it was good, they had a little mini movie. They'd made a little documentary about the band behind that song in the movie, Oh Yeah. Remember that? It was ubiquitous at the time. Oh, yeah. It's a band called Yellow, and apparently they had a whole big following. It was a big phenomenon.
But it wasn't just that one song.
Well, that's the only song everyone knows of, so that's what got me thinking about one-hit wonders. But we're not talking about that kind of one-hit wonder on today's show. No, we're talking about a different kind of one-hit wonder, which are one-hit IPO wonders. You might think of a company like Bird.
The scooter company.
Electric scooters. You might think about Peloton, maker of the fancy exercise bike.
That everyone bought during COVID.
Everyone bought during COVID and then never again, speaking colloquially. Fitbit. We can all name companies that had a great hit product and then went public and didn't really make it as a public company. They either fizzled or got acquired at a price lower than where they went public. But despite that long history, people keep trying to do this. And so, of course, as we're looking at the markets today, there is a new generation of companies trying to go public on the success of a hit product and pitching that as a big sustainable business. And the one that's on our minds in particular this week is Oura, the maker of the bioscience health tracking ring. They have put in the filings to potentially do an IPO.
And then we've also reported that Whoop, which makes a bracelet type device, maybe kind of similar to a Fitbit, is thinking and planning an IPO itself.
All right, so we're going to have a conversation with an analyst about whether or not these one-hit wonders are maybe going to do a little differently or better than past IPOs of hot consumer companies.
Yeah, can they buck the trend, I think is the really big question.
Because some do. Not every company doesn't hit that escape velocity of becoming like a big sustainable business.
That's going to be really interesting. But first, I think we need to talk about what happened in the market this past week with the big tech stocks.
Yeah, the market's kind of been a little all over the place with AI related stuff this week. Early in the week, we saw big price plunges for Samsung and SK Hynix. Those are two of the companies behind South Korea's own AI boom, which, by the way, the Journal's been doing some great coverage of kind of economies across Asia that have been feeling like this gigantic wealth creation from what's going on in the market in AI. But then later in the week, Micron stock surged after it reported blockbuster earnings, quadruple revenue growth and stuff. That also helped a rebound in SK Hynix's stock as well. And then on top of that, you had Apple saying that it was going to raise the price of MacBooks to reflect the fact that AI is buying up all the memory. And so memory costs are going up. So, I don't know if the worry has been taken out of the market, but I don't think that this was the week that the trade unwound and this is the end of that trade. I just don't think we're at that point yet.
I don't think so either. I mean, we're really kind of going back and forth. Like, Telis, you were so prescient on that episode with Kevin Kuharki and John Weil talking about, the hidden costs of the AI infrastructure build out and how it's not showing up in cash flow statements. Because the market seemed to, wake up to that this past week.
Yeah. The worry about can companies actually afford this giant build out of data centers, hiring engineers, developing new AI-based products. It's going to cost trillions of dollars, and who's going to pay for that? Whose pocket does it come out of? I think the market was a little bit spooked when SpaceX came to the market to raise a bunch of debt this past week, right after it went public. Now, I don't think the market should have been that surprised because if you'd read the IPO prospectus, you'd know that they'd borrowed some money from their banks they needed to repay back.
So they already
with
told
debt.
investors they were going to be doing this, basically.
Yeah, but as is often the case in the market, nobody read the fine print, and then when the news came, people said, "Wait a second, even SpaceX needs to raise money," and among the reasons was because it has negative free cash flow. It isn't generating money currently in its business that it can reinvest, so it needs to go out and get it from the market.
But as you and Kevin and John discussed, this is happening even with companies like Meta and Alphabet, very deep-pocketed, profitable companies that are having to tap the debt markets in order to finance their AI build-out.
Well, and also the equity markets, too. You had Google's giant stock sale, and that in particular is something that might really kind of worry some investors because stocks are like anything else. There's supply and demand, and we know about the demand side of the market. We talk about that all the time. And the supply side is, well, who's selling shares? And so if more supply is coming, what does that mean to the clearing price of the market?
And another thing you guys talked about on the episode, which I thought was so interesting, was, how companies are actually laying people off, potentially in order to free up cash to finance the AI build out. And we saw perhaps an example of that this past week with Oracle announcing a big layoff. I think the instinct is to say, oh, these people are being laid off because their jobs are being replaced by AI. But it's actually not quite that. It's that they're being laid off so that AI infrastructure can be built, which may then someday replace their jobs, I guess.
That's a really interesting way of framing it, Miriam. And I do think that is one of the many trillion-dollar questions in the market today is when companies say, we're doing layoffs, is it because AI is starting to achieve some of the efficiencies? We know that when Block, for example, did a large layoff, that was part of the rationale that they gave, that they are using more automation in their business. But I do think there's still a lot of skepticism that maybe these are just opportunities for companies to cut some of the fat and, again, free up more of their resources to invest in AI in the hopes that it gets to that efficiency. And so maybe these layoffs are maybe putting the cart before the horse and represent kind of a risky move rather than a sure bet on, hey, we're saving a lot of money here. In both cases, though, it results in some people losing their jobs, and that adds to concerns about sort of the overall health of the economy, despite this geyser of money coming from everybody investing in AI.
Totally. And speaking of jobs, this coming week we have a jobs report, so it will be interesting to see if any of this AI-related spending and layoffs are showing up in that report. So far, the job market has looked pretty healthy.
Well, and I know that jobs reports are hard to read. We've talked a ton about this on this show because there's the population element. Is the economy losing people? And so therefore, it doesn't have to create a lot of jobs to have full employment. So I don't know how much we'll really get out of this one particular report, but I do want to call out that in the wake of the way that Kevin Warsh, the new chair of the Fed, has been talking about how the Fed's going to go about doing business. And by that, I mean the Fed is not going to give a lot of hints and guidance about likely next rate moves, which means that the market will have to read a lot more into economic data to figure out how that might influence the Fed. And so I think there's a case to be made that economic data could be an even bigger source of kind of market trading and volatility than it normally is. So, whatever is in this report will be parsed. I mean, the market always looks at these things closely, but it could drive even more volatility than we're used to.
Well, speaking of jobs, somebody got a new job recently, and that is the new CEO of the company formerly known as Allbirds. Now, remember, Allbirds made shoes, this one specific kind of mesh type of shoe that was worn a lot in Silicon Valley.
It was a hot thing.
It was
for a little,
hot
not
thing.
just Wall Street too. Remember, bankers started wearing Allbirds.
Yes, that's
that was a
true.
big moment.
They were very comfortable. I mean, presumably. I never wore them. I would not be caught dead in those. Sorry.
Well, and listen, give them credit for noticing that like everybody now wears sneakers, but the Allbird product itself was not a runaway hit over time that people expected it to be. So the company has pivoted.
It didn't have staying power. So they sold their footwear assets, and they announced in April that they would pivot their business to AI infrastructure. There you go. It seems to be a hot theme these days. But really, that is kind of a desperation move, I have to say.
Well, or it's a smart defensive pivot.
If you can make it AI, it might sell to the market.
And I think that is going to be part of getting back to the theme that we started the show at, companies that are going to go public with a product that they will likely position as somehow benefiting from or driving AI adoption. And in the case of things like Oura or Whoop, things that are producing data about your body, and you can imagine that could potentially be a very big business if people really make AI part of their daily habits and use these devices to monitor their health.
Well, that sounds all well and good, Telis, but our guest today, Stephanie Davis, has a bit of a different take. I would say maybe a more realistic, or you could say pessimistic take on the potential fate of these companies.
Trying to look at the bright side of things once in a while.
Stephanie is a former research analyst at a bank where she followed these health tech companies, and she now is a consultant and advises health tech firms. So I think she has a lot of knowledge about this area, and she's seen the graveyard of companies that have littered the past. Stephanie also has a new podcast of her own coming out called Rounds that is going to be focused specifically on this area.
We wanted to get a little sneak peek of some of the stuff that she might be thinking about here on her own show.
That's right.
Well, we're going to have that conversation with Stephanie Davis after the break.
Stephanie Davis, welcome to Take on the Week.
Thank you so much for having me here.
So earlier this year, Oura filed confidentially for an IPO. They make the Oura Ring, which a lot of people have. And as of last October, the company was valued at $11 billion. That is a really big company.
It's a lot of rings.
Yeah.
A lot of rings.
And Oura said it was on track for $1 billion in revenue in 2025. Now, we don't know its exact numbers yet, but what are the components, do we think, of its business?
Well, I think they really tapped into the wealthy well, right? They had a better form factor, the ring, versus a lot of folks had a clip or a bracelet or a watch. It's easier to wear the ring all the time. They had a longer battery life, which I was at a health tech conference. I polled folks on their wearables. They were very passionate about it this past week. And a lot of folks said that the battery life for Oura meant they could wear it for multiple days. They could get all their sleeping data.
Battery life is really important.
And I mean, you probably see this in the meetings you're in. It really appeals to the high end of the market, which has a lot more dollars to spend on different wellness tech. But from what I can tell from the business model, it's based on hardware sales as well as a combination of software because they have a subscription model.
And how new is that subscription model? Have they always had that since the beginning?
I actually wouldn't know.
You don't have an Oura Ring, I guess.
I do not have an Oura Ring. I'm an 8 Sleep user. But they've also moved to that model. And you've seen that. Like Fitbit, when they first came out, they had a hardware-only model. And then they acquired a health tech company 1 or 2 years in or so after they came public, and they started trying to go and introducing a subscription. Because otherwise, it's really easy to cannibalize your own revenues.
And that's really the key to the business model, because once you sell somebody a ring, especially if it's a nice consumer product, they're not going to be replacing it every year. And so the idea is to get them to then buy something from you, every month, every year, and that might be a subscription. And they're not the only type of consumer company that's moved to this model, right?
Completely. I think a lot of the monoline consumer products, right, think about the graveyard of them, the GoPro, the Roomba. I believe LV got acquired by Willow, right? Everything that sold one product and you bought it and you were done kind of needed another revenue source.
And these subscription models, I mean, it kind of harkens back to the software as a service, business software companies where they charge a monthly subscription, and the market in the past has valued that very highly because it's predictable revenue going forward. Although recently, these software companies have kind of developed a dark cloud over them because a lot of people think they have a threat from AI, or that they face a threat from AI. But
SaaS apocalypse. Right?
Yeah, exactly. And we've talked about that on this podcast. But do you think that, having a subscription business model could be a way to generate a higher valuation for Oura? Could that be a successful strategy for them?
There's pros and cons, right? I mean, first of all, Oura has a very generous valuation, so whatever they're doing is really working. But if you look at historically the hardware revenue streams, they tend to command a much lower valuation. SaaS revenue streams do have a higher valuation, but it does cause friction. This is all anecdotal, so take it with a grain of salt. But I've heard a bunch of folks that have used the Oura Ring, started having to pay the subscription, and said, well, these insights aren't that insightful for my day-to-day. Who doesn't know when they're getting a bad night of sleep? Or if maybe having that extra glass of wine probably won't let you have the best day tomorrow. But paying for that every month can be a bit frustrating. It's consumer friction.
But then at the same time, I think a lot of us forget that we have these charges recurring on our credit card, and we just,
Guilty as charged.
let them go on for eternity.
But the bull case for something like this is that unlike software companies that are going to be disrupted by AI, right? Like that was the driver of the SaaS apocalypse. These companies are instead feeding into AI, right? Like I want to use more data about me, my life, my body, my health, because I want to use artificial intelligence to then give me insights about myself. So the case that these companies might make would be, we are actually beneficiaries of AI, unlike, just a piece of business software, because the data that you get from your Oura Ring or whatever it might be will then feed into the tools that you're using, on your phone to ask questions about, oh, what should I be working out? What should I be eating? Do you think that that's a strong case, that these companies are the tip of the spear for that kind of bioscience economy?
I would be hesitant to go as far as calling them AI companies, right? I think they're another one of the many sources of data that we get. But and this is someone who has looked at healthcare data for a very long time, but I'm kind of a viewer of the diminishing marginal returns of that incremental healthcare data point. We have so many data points in healthcare. You have your electronic health record, you have all the different wearables, you have your step count data. And I think a lot of folks thought that you could monetize that data at first. There's a finite wallet to buy that data, and there's an infinite creation of that data every day. So it's really hard to get a lot of value out of it.
What about in a medical setting? Like, can this data be used to actually improve health outcomes?
In theory, it could, right? I just think there's a self-selection bias. The folks that are so engaged in their healthcare that they're wearing an Oura Ring and they're paying that subscription every month, they're probably getting their steps in and eating right as well.
They're already kind of health nuts.
Exactly. It's the my dads of the world. It's so a story I always like to tell is I picked my dad up from a heart surgery and he said, "Excellent. We're in New York City. Let's get a hot dog."
Not the best for your heart.
Not the best for your heart. He's probably not wearing an Oura Ring.
Right. But you know who is wearing an Oura Ring? It's funny. Every meeting that I go to with people who are like at the top of their game in the financial world, people who work in finance, they're all wearing Oura Rings.
We're all optimizers, right?
Yeah. I mean, those are all like type A high achieving people, I think. But I don't wear an Oura Ring. And I know a lot of my friends don't wear Oura Rings.
I'm ring free over here.
Yeah, exactly. So have all the people who are going to buy these Oura Rings bought them? Is there a risk of that? Like, is there a risk that we're already at the peak of adoption for these products?
That's always the risk with device companies, right? I think you have everyone buys it. It becomes like a very big trendy product. And then it gets to a scale, $1 billion, where the company says, maybe we should go public. Mm-hmm. And then the risk is who's the incremental buyer in that meeting you're in of another Oura Ring. So you have to have a product replacement cycle. Sometimes there's slower adoption there. And growth can erode from that.
And I think it raises the question of, how big does a consumer tech company need to be in order to go public, right? I mean, maybe they've reached a critical mass. Clearly, they're a big company now, $1 billion in revenue. That's not nothing.
Nothing to check a sec out.
But, is that what's needed to go public these days as a company like this? And then, obviously growth is important for a public company. What's going to be the next leg?
It's the push-pull of those things. I think historically when you looked at a lot of health tech companies coming public, the hurdle was way lower. It was $100 million of revenues, you were approaching break-even in profitability, and that was enough. Those smaller cap names didn't fare as well over the past few years. And I think you're seeing a lot of folks wait until they're more of $1 billion of revenues and can get that, double-digit billions valuation to come out. At the same time, it probably means that a lot of the growth that happened on the private side. And so you might not be getting the same sort of growth arc as a public story. We'll see. I do think scale helps a lot. Having a large market cap definitely attracts more investor attention, as we've seen with SpaceX, but yet to be proven how sustainable that is as a IPO strategy.
What's a cautionary tale in healthcare tech? What was a past
All of them.
cycle? All of them. Give us an example. What's a company that got really hot, tried to capitalize that with an IPO, and then just kind of hit this wall of there are only just so many more units we can sell, and the subscription business has its limits?
I mean, Fitbit is an excellent cautionary tale, right? They came out at 30 times PE in 2015. They doubled pretty immediately within a few months to 60 times PE. And then by the time they were sold in 2021, I mean, the stock was just a straight line down. They didn't have any earnings left to speak of, so I can't even reference a PE when they were sold.
And just so everyone knows, PE is price to earnings ratio. Most of you probably know that, but it's a very common way to value a company.
And so what happened to them? Was it that they ran out of people who needed one but didn't already have one? Was it that some of the ideas around, now that we're on everybody's wrist, here are all the 10 other things we'll sell them? What was the thing that ultimately led to them making more sense as an acquisition rather than as a standalone company?
As I referenced before, being a monoline consumer product is incredibly hard because then you're really going to be stuck with a product replacement cycle. And so they started releasing new products, but how many new products can you really release at that pace? Some of them didn't hit with the consumer, right? Some of them were a little too expensive. I think their Ionic product was perhaps too premium price for the market at that time. Then you also saw a ton of competition. It's exactly what happened to Roomba, right? Roomba came out with a great piece of technology, and it spurs a lot of copycats. Fitbit did, and then they saw some low-end copycats that covered the low end of the market. And Apple entered the high end of the market. That's a tough one to compete with.
My Roomba is just sitting under my couch collecting dust because between my toddler and my dog, it is not getting a lot of action.
Has anybody successfully taken an early success? You've got one product that has sold really well, you've got a great audience for it, and then used that, either the financial firepower that gave them or just the momentum as a company to continue to innovate and either add additional products or to solve the product life cycle. Is there an example of somebody who has achieved that transformation into becoming a broader company?
Now I'm less of an expert on it because it's outside of healthcare, but Garmin, I think, is actually pretty
We
good
were just
example.
looking
We were
at
just
that.
marveling at, we hadn't checked in for a while. That's a $40 billion plus market cap company these days. It's a long way from
Crazy,
just
right?
the...
That is a huge company.
GPS
My
on your
mom's old
dashboard
GPS
business.
on
I
the
know.
dashboard when I was a
I
kid.
remember my dad had one that he held in his hand, and he would go hiking, and he'd be like, "This is where we are," and hold it up in the air.
They've come a long way. But yeah, they expanded into a bunch of adjacencies. I think they had some core tech that made a lot of sense that they could expand into other markets. They even went to health trackers. So there's a lot of expansion that helped them. I think flip side, there's a lot of single products. Allbirds.
Yeah.
Finally got rid of them. May they rest in peace. I love
Now they're
those little gray shoes.
Smartbirds, right?
These were
Yeah.
these were the simple but super fashionable gym shoe, right?
I don't know if they
when,
were super fashionable.
Well, I remember there was a moment when big
I wore them a
CEOs
lot,
started
so I
wearing
want to pretend
them.
that they're fashionable.
They were fashionable among the tech set, and you're adjacent to the tech world, right?
That's how I justified wearing them instead of heels.
They were very comfortable, right? That was their thing. They're no longer a shoe company. They're an AI infrastructure company, and they're called Smartbird now. So really,
Very generous. Very
Completely
generous of you
gave
to call
away
them
their
that.
business model. They just gave it up.
Are there markers, though, that could help you identify? If I'm an investor and I'm looking at kind of some of these hot companies, and I might be trying to pick one that's, okay, this is the next Garmin. They're going to actually continue to grow and lean into their strengths, or this is the next Allbirds, where great fad, great product, maybe not a sustainable long-term kind of business. Are there any things that you would look for? Is there something in management or strategy? What would be some markers?
Honestly, I think you need a track record of innovation and execution to adjacencies. I'd probably argue that if you're going to be a public company, having a monoline product is not the best move.
Mm-hmm. You should have already branched out before you went public.
Yeah, given all of the different examples we've mentioned so far on the podcast. And so that takes time. I think that takes a patience that a lot of VC-backed companies don't really have the ability to have. Mm-hmm. And so that's why we get the Pelotons of the world.
Does it even make sense for one of these consumer health tech companies to go public? I mean, I think we're kind of getting at this question. Should they instead be pursuing a sale to a larger technology company?
I've always been a big believer that a lot of these consumer health tech companies are worth so much more owned by one of the large tech giants. If you look at the large tech companies, the Amazons or the Apples or the Googles, they all do well by having a superior consumer experience, right? Why do you use, this is vintage, but why would you use Google over Ask Jeeves? Because Google worked better,
right?
Why do I like my Apple products so much that I panic when I have them get broken or lost? Because they kind of just make my life easier. And so adding a wearable into that ecosystem increases the stickiness and the value of what they have to offer. And so you can argue that while Oura is only making a finite amount of money from selling you their ring and then selling you that subscription, if it was owned by someone larger, there is a lot of a broader halo of value that comes out of it.
Mm-hmm. Like they could connect it to the Apple ecosystem and be getting the data that, from the ring, from the watch, from the phone.
It makes you a happier consumer. It gets data about where you are and how your health is, which I'm sure has a lot of different follow-on effects to different Apple products. Like something like that could be very valuable.
So given the fact that we've enjoyed our walk through the cemetery of, looking at the different gravestones.
Of monoline consumer products.
Such a charming time.
I remember when that was hot.
I love a good gadget, too. I have so many of these.
They're very successful when they're hot. People love them.
But that's why they grow so fast.
Exactly.
But why then do companies keep trying to go public to do this? Is there something about the VC ownership structure that means that an IPO is just the best for those investors? And even though a sale everyone looking at it might kind of quickly say, well, that would make sense as part of a larger product. And not to pick on them, but for example, Lime, the electric scooter company,
oh my goodness,
has recently sort of gone in the direction of trying to go public. A few years ago, Bird went public, and they didn't last as a public company. So what is it that makes people want to keep trying to do this, even though we've seen so many others stumble?
Not that I would ever call an IPO easy. I think that would be unfair to all of the companies and all of the haggard management teams that had to go through the process. But it's a much easier process to exit than finding someone to acquire you, especially when you get to a certain scale, right? How many companies could buy $1 billion revenues, $11 billion valuation Oura?
Mm-hmm. And a lot of companies go public and then are later acquired. So it doesn't close the door on an acquisition.
And dual track processes, especially in health tech, are far from unheard of.
Now, a dual track process would be to, while you're working on your plans to go public, you would also, in the background, be working on trying to find a buyer. Right?
Correct.
Yeah.
And I remember from covering IPOs in the past that sometimes saying you're going to go public or going public is a way to sort of force some buyers who might have been reluctant to say, okay, I'm either going to pay, I could pay this price today, or take the chance that this company goes public and the valuation goes up and I've got to pay more tomorrow.
And as a former financial analyst, I spent a lot of time building models that will never see the light of day for that very reason.
Oh, wow. Okay.
Interesting, because the deal actually happened before the IPO.
Exactly.
I think that seems like an ideal outcome for some of these companies because, as we've seen, the alternative has been the IPO. Maybe it rides high for a little while, then it usually craters, and then it gets bought for much less than it went public for. So it seems like it would be better to sell before going through all of that.
Agreed. I think it makes a lot of sense for if you're a consumer tech product, right? That Peloton would feel very differently if they had sold as opposed to going public.
All right, we're going to take a quick break and more with Stephanie Davis when we come back. All right, welcome back. As an analyst, I want to ask you about, because we talked about this with SpaceX's IPO a couple of weeks ago, and it seems like this is always a number that people really focus on and that makes both the bull case for a company, but also ends up garnering a lot of criticism for a company, and that's TAM, total addressable market.
TAM.
What is it? What is a reasonable way to look at a TAM, and what is I'm really just trying to get a big number out of my model way of looking at a TAM? As a financial analyst, what do you look for that tells you this is a good number and you should really take this number seriously versus, okay, this is just kind of, sort of
pie in the sky,
pie in the sky stuff.
So I think taking TAM seriously is an act of hope, if I want to be very positive on it. Oftentimes, it is a very large number because you have to think about the total addressable market and what company wants to limit their addressable market.
Right.
I often calculate my own immediately addressable market. And so I think what's valuable in TAM isn't what the number is. Mm-hmm. It's probably very big. It's how they calculated the number and then making your own reasonable assumptions to go back into it, right? Like if I wanted to say the TAM for Allbirds, it's probably everyone with feet.
Everyone who buys sneakers, which is most people.
Right.
Yeah.
They had Smartbirds, the little kid one, so even those that don't.
I didn't know about that.
They're so cute. But that just, you can really get away with those numbers. And so I think you have to go and take a much more reasonable thing. SpaceX, when you look at their TAM, I think that got a lot of humor rounds from the financial community just because the majority of it was AI, in which the TAM is, anyone's best guess.
Right.
But that's great advice for an investor to do. One relatively straightforward thing you can do is go to a company's model, look at their prospectus, and then just sort of insert your own kind of TAM number, what's more reasonable, or let's just trim this in half and see if the company still makes sense at this price. That
total immediate market. I liked that.
Yeah. Think about it this way.
The TIM.
Not the TAM, the TIM. The TIM. So I know, Stephanie, we've been talking about the dangers of being a monoline company in the consumer space. But clearly there's some big opportunity here because it's not just Oura that's chasing health tracking data. You have Whoop, which if you don't want a ring, you can get the bracelet. I think I've heard that there are earrings coming out that kind of do the same thing.
It's trying to appeal
now,
more
those
to
I might
health.
wear.
Well, so clearly there's something in the air that people think is going to be a big opportunity. Who do you think might make money from bioscience wearable data tracking?
Look, I think a lot of early innovation tends to happen in the consumer market just because consumers are willing to pay for neat gadgets, as we've seen from just the folks here at the table. But a lot of the true innovation and where things will bend the cost curve is getting that into folks with chronic conditions, right? Getting some of these wearables and these different devices to folks that have, chronic kidney disease or diabetes or heart failure. I remember being amazed. I was wearing my Apple Watch, and I remember I used to call it pet rock. I thought it was such a silly thing. But I fell when I was on a hike wearing it, and it immediately said, "You need me to call an ambulance."
Wow.
That was phenomenal. Wow. And so having
Life alert, remember this.
Right, exactly. Yeah. But having all of that available and on some of our more chronic populations, like that's a huge opportunity to go and reduce cost. And that's something, once it's a little bit more clinical data that could actually be linked into the hospital, I think they'd find it a bit more valuable.
Right now, unfortunately, a consumer is required to actively go out and purchase one for themselves. So as you already said, these consumers who are potentially most in need of this service are not necessarily going out and doing that.
Correct. And it's not really linked into your EHR, your electronic health record.
So then what's the business model then? Is this something that will benefit hospitals that are going to white label some piece of technology to patients that need it? Is it going to just accrue to the Apples of the world that already have devices on your hand, in your pocket, in your ear, and is just more of an opportunity for them? Who will make money from this?
If you want to argue that Oura in some distant future goes into a more clinical setting, it probably then gets reimbursed by the payer. Your health insurance, because they want to make sure that you're healthier and you're better cared for. I think the business model is I don't want to call it $1 million question. It's the $1 trillion question within health tech, because so many folks have tried different things. Per member, per month fees, right? Different fees charged to the employer as they get more employee monitoring. No one's really found a ton of success yet in a sustainable model.
So I want to go back to thinking about the investor, which is the listeners of this podcast. I spoke with a professional investor about the fact that we were doing an episode about, the Whoop and Oura IPOs or possible IPOs, since Whoop has said it's also considering an IPO. And he
Might
said,
as well get in the bandwagon.
Exactly. He said that, as soon as one of these single product tech companies files for an IPO, we know what to short. And so what does that mean? If that's how professional investors are thinking about this, what does that mean for retail investors? Like how much should retail investors even get involved with these stocks?
Look, I think retail investor participation has changed in a dramatic fashion in the market, right? We've seen that with the SpaceX IPO, about a lot of retail investors getting involved. And there often are initial pops. Do I think any of these wearables are a sustainable business model longer term? No, and that's probably what that investor is saying. But it's always a question of timing, right? I think a lot of times a familiar product, investors on the retail side like to get involved because it's something that they know and they have understanding of the look and feel. Don't forget Fitbit doubled before it dropped down dramatically.
So you could have made a lot of money if you sold at the right time.
You could have made a lot of money if you sold at the right time and you participated in it.
And you raised something earlier that I think is relevant too, which is that these companies often wait later in their evolution to go public than they used to. Rather than saying, hey, we've sold a few of these things, we think we'll sell a few more, let's take it public when we're a maybe even sub $100 million revenue company. Yes. Now they're getting to, kind of S&P 500 grade valuations and then going public. Do you think that makes their IPOs less compelling, that they're waiting longer and going public as bigger companies?
I think there's puts and takes to that, right? Waiting that long means you're probably leaving some growth on the table, but it means you're a more established business.
Yeah.
How many 100 million of revenues companies or sub 100 million revenues of companies came public and then realized they were more of a concept than a true product or ecosystem?
I think that's the message that the IPO market of today is sending loud and clear, which is that companies are waiting much longer to go public, and they're waiting in general till they have a more established business model, which means that public company shareholders aren't experiencing that growth or the runaway success of like an Amazon.com, but they, maybe have more staying power, or at least the companies hope so.
Well, look, like good concepts are good concepts, right? Remember when Uber came out, I think a lot of folks were waiting for far too many months and years on the sidelines saying, when will this come public? And it's, even if you got in around the IPO, like you've made money.
Yeah.
There you go. So it's not every company that comes out with a sort of new model that doesn't make it. There will be some that maybe, hit that next, although Uber was such a big company already.
It was a very big company. But think about any valuation you got in for Amazon. If you got in earlier, you did well. You're probably pretty happy right now.
But are those days over of being able to find the next Amazon? Because I think that's everyone's dream, right? You buy something when it's a tiny little monoline and then suddenly it's the world's largest, retailer, compute power company. Is that just an unrealistic dream to think that that's what's on offer in the markets today?
I mean, AI is changing our world so much that you're seeing college students terrified of it, booing folks that mention it in their commencement speeches. I'd argue we're probably at the cusp of a lot of Amazon-esque moments.
Interesting. Well, Stephanie, thanks so much for joining us.
Thank you for having me on the program. I really appreciate it.
We didn't get into Long Island iced tea.
Long
Island blockchain.
Yeah.
That's okay.
I don't think I even remember that.